Without further ado, please give a nice warm welcome to the future-proof stage to our next panel to discuss tokenization for RIAs.
All right, hi everyone. My name's James Seyfert. I'm a senior ETF analyst, research analyst at Bloomberg Intelligence. Mostly people know me for covering the crypto ETFs. I do a lot of work covering the worlds colliding between crypto, DeFi, and TradFi, traditional financial world. And we're gonna get into tokenization, but before I do that, I'll let my co-panelists talk about what they do and why they have any semblance of anything to do with tokenization.
Hi everybody, my name is Jason Broder. I'm the Chief Product Officer at iCapital. For those of you who are not familiar with iCapital is really meant to democratize alternative investments for the retail investor. What it does is create a marketplace that brings together GPs with the wealth management channel to make it easier for wealth managers to use alternative investments in the portfolios of their clients. As this market gets more and more big and we try to scale, there's obviously a huge problem that the underlying infrastructure is relatively archaic. And so not only are we a marketplace at iCapital, but we're also making a heavy investment in the underlying infrastructure to really help drive the scale across all the alternative investments lifecycle. But nice to be here. Thanks, everybody.
Okay, my turn. I'm Zach Pandel. I'm the head of research at Grayscale Investments. Grayscale is the largest crypto-dedicated asset manager in the world and one of the oldest. We run about 30 different products offering financial advisors and any other investor to get access through regulated vehicles to the crypto ecosystem. And my work is essentially as like a crypto financial analyst, the same type of work that an equity analyst or some other fundamental analyst might do. We're just studying blockchains and their use cases and trying to understand which ones have value, which ones will deliver investment returns. So tokenization is a use case of blockchain technology, something that you might use Ethereum, for example, to do, something that drives value to these assets. So that's how we use it, sort of input into the investment process for the blockchain tokens that are on our platform. And delighted to be here with my panel to talk about all this today.
Yeah, so when you think about tokenization and crypto in general, what I find is like there's probably a lot of people at this conference that they look at this and they think it's just pure speculation. There's a lot of scams, there's frauds, there's nothing of value here. And then you also have people on the DeFi side of things, probably more where Zach kind of sits, that like they see the technology, they see the old school technology and how it's broken, everything is going to go on chain. They see the pure idealistic view of things, and like most things, it's somewhere in the middle. So tokenization is one of those things where it has already found product market fit in certain things, namely stablecoins. But maybe like Zach, if you could just give a definition, like what is tokenization, like, before we get in?
Yeah. Tokenization just means taking an asset, any asset, cash, bond, stock, real estate, and representing it in the form of a token, meaning a bearer instrument, something that can be traded peer-to-peer, between you and me directly without an intermediary. So a tokenized asset, taking an asset, putting it in tokenized digital form on a blockchain. That's all we mean. The simplest version of that, as James mentioned, is a stable coin, which is a very buzzy topic right now because of new regulation passed through Congress in July. But stablecoin is sort of the simplest form of tokenized assets. It's just tokenized cash. It allows us to trade a digital cash-like instrument on a peer-to-peer basis. And tokenized assets, tokenized stocks, bonds, also pretty buzzy today, are just extending that same idea to the world of investable assets, putting real-world assets, investable assets onto blockchain infrastructure.
So do you have anything to add to that? Any different view? All right, so let's get into this, right? So there are people out there that think like the entire world is going on chain at some point in the future. ETFs,
That's what
stocks,
I'm
bonds.
one of those people.
Okay. Let's start with you then. What's the timeline? Like, when is everything going to be on chain, and what is it going to look like for an advisor that's using these things? Are they even going to know that they're using tokenized assets and tokens, that they have a wallet, or is it just going to be the same sort of infrastructure they have now?
Yeah. Maybe this is a good way to do it. I will give the kind of vision, the hope of where we're going, and Jason can bring us back down to reality and like how the world actually works today. But yeah, I think the vision is basically you as an asset owner. The experience isn't all that different. Think about going onto your wealth platform and trading a ETF or a stock or a bond. You press buy or sell and something happens. Right? The goal is just that the usability of those functions is better with blockchain technology. So you can do those transactions on a weekend or a public holiday. You don't need 2 days to let them settle. You don't need to trade between a stock to cash to another stock. You can trade 2 stocks against each other. You can be anywhere in the world and trade US equities. So the vision is that we can change the kind of back office infrastructure, the underlying digital infrastructure that runs our financial lives, move away from the sort of credits and debits and custodians and other sort of infrastructure providers that we have today onto blockchains with tokenized assets to get more functionality. So the hope is that you do all the same things in the future that you do today, you just do them better. Now, it's going to take a long way to get there, and maybe that's where Jason can come in.
Yeah, we're definitely not at that level yet. For some things, maybe stable coins in some regards, but nothing else.
Yeah, and remember, I'm coming from the standpoint of private markets specifically. So are there folks in the audience that buy alternative investments? Go see, show hands. Yeah, is it easy? Is it hard? Is it painful? Is it seamless? I'm getting the nods for the painful I saw. So yeah, so I'll say 2 things. One is, if you tokenize an illiquid asset, you don't make it more liquid. So that's always something to keep in mind. Just by semblance of tokenization, it's not going to take something that you can't sell and make it obviously a more liquid and introduce more buyers. So that's number 1. But number 2 is, when we think about the concept of tokenization, I mentioned earlier the infrastructure in private markets being archaic. We think about the distributed ledger technology, which I'll use interchangeably with blockchain. The distributed ledger technology is really enabling a massive uplift in the underlying infrastructure for private markets. And why is that important? Well, because given how painful it is right now to invest in alternative assets, it's really because think about ETFs or mutual funds 30, 40 years ago. You're emailing PDFs, there's CSVs, there's no single source of truth, there's certainly no seamless transfer of data. But the distributed ledger technology is actually a way where we can make it a lot more powerful and a lot easier. So I say the infrastructure component is a precursor to tokenization, but you don't necessarily need to be buying and selling tokenized assets to get the benefits of the distributed ledger at this point.
Yeah, so also there was some news recently, like the DTCC, the Depository Trust Clearing Corp, they're also looking to use blockchains to do all this type of stuff, right? So this isn't like some pie in the sky type thing. NASDAQ was talking about this. There was a press release yesterday where they talked about doing this, tokenizing stocks, tokenizing ETFs even. So this is happening. But I guess from your point of view, like, how far away are we from actually seeing this stuff being done? Like, how far are you guys away from having tokenized alternative assets that it's much easier to buy and handle?
So right now, our distributed ledger technology is rolled out. It's being used by GPs. It's being used by wealth management clients. For financial advisors who are at one of those firms, you probably don't even realize that you're leveraging the distributed ledger technology. It's still early days, but we've seen a lot of uptake. Again, we're not buying and selling tokenized assets on the distributed ledger technology. In order for that to happen, your clients are going to need to get comfortable taking US dollar, converting it to some type of stable coin within a digital wallet, and then using that digital wallet to buy or sell tokenized assets. I don't see that happening tomorrow. I probably don't see that happening anytime in the next few years. Of course, you would have a better sense, and this is just based on conversations I've had with many financial advisors over the years. But that's why, in my view, I do think we are a ways away from that. Again, not to say it can happen. The good part about our distributed ledger technology is it's future-proof. If tokenized assets take off tomorrow, we can launch a tokenized fund tomorrow on the distributed ledger. If it takes off in 5 years, we'll be able to support it then, obviously, as well.
Yeah, so we've seen Galaxy Digital, Mike Nogratz's company, just did tokenized stocks. One thing I do want to point out, a lot of the stuff that's being tokenized right now tends to be like, it exists somewhere else, it's held in a custodian, and then it's like some SPV, some special purpose vehicle that's holding this asset. There's custodian risk, there's counterparty risk, but the real future is not that. It's more what Galaxy has done. So I guess, one, can you just talk about like the nuances there, add on to what I said, and also how far away do you think it is that we're actually going to see this whole system interacting with each other?
Yeah, good question. So when we talk about tokenizing something, I can just give you a kind of claim, a paper claim on some special purpose vehicle and stick that thing on a blockchain. That's not that interesting, but new equity issuance, new bond issuance directly on blockchain, that's sort of a bigger step. That's what Galaxy has done. It's very cool to see. Look, it's not a 0 to 1 kind of thing. Like one day we're in a not tokenized world and the next day we're all the way there. I would say that we are in equities and private credit. We are still in a proof of concept sort of stage. It's not widely rolled out. In stable coins, we're much further than that. We have real world adoption in lots of different places around the world, and we're getting a little bit beyond that in things like tokenized treasuries. So if you're a crypto native business, let's say you are Galaxy Digital, for example, a crypto native NASDAQ listed company, and you want to do cash management, one of your options is to hold that cash in a tokenized treasury fund. So I would say that we're getting beyond proof of concept. Now, what inning are we in? I think we're still in the top of the first, bottom of the first inning, something like that. The game has started. It's not like this is we're nowhere, but we have a long way to go. So the vision will take us 10, 15, 20 years, but that's the same as ETFs, as James, you know well. You know, ETFs have been around for a long time, but they're still capturing market share from mutual funds today. Tokenized assets will take a long time, you know, and they'll continue to capture market share 15, 20 years into the future. That's the vision. We're at the early stages of a very long process, but I think it's definitely gotten started.
Let's get into the pros and cons of tokenization. We've talked a lot about the pros: 24/7 trading, atomic settlement, you name it, custodying your own assets. What other pros am I missing? And then let's talk about some of the cons. Aside from, we'll get into regulatory in a bit, but let's talk about pros and cons.
Yeah, I think the one thing we can all leverage the distributed ledger technology for is, again, I'm talking from the standpoint of private markets specifically, not necessarily public equities. But when it comes to private markets, it's riddled with pain points. There's no single source of truth. There's no standardization of any data. And as a result, when you are trying to put these products into your clients' portfolios, it's painful. It's a lot easier to buy a publicly traded ETF or mutual fund, obviously. So what we can do with the distributed ledger technology is actually represent these investments as smart contracts. And we can describe the underlying data model in a standardized and consistent way. And now, instead of emailing PDFs and CSVs back and forth, there's one source of truth. Everybody, in general, the way we've done it is conforming and plugging into the model via API. And so when you're sharing information back and forth, you can permission the contract such that only the actual investor has permission to see it, to touch it. And so think about the way in which private markets work today. There's a GP, there's a wealth manager, there's a custodian, there's a fund administrator, there's a transfer agent. Again, everybody's emailing PDFs and CSVs back and forth. But now if everybody had one single source of truth on the ledger, and everybody had permission to see only what they were allowed to see, and the smart contract that represents, say, the private credit fund has validation logic built into it, so it knows, is there a capital call, is there a distribution, who owns this? And it can literally streamline that entire end-to-end life cycle of a fund, which today takes, ask anybody who's a GP, it takes hours and hours and a massive team of operations folks to actually do that. So we think the pros, by leveraging the distributed ledger technology, again, whether you're tokenizing the assets or not, is to drive massive efficiencies into the entire process and really get to that 10x scale that I think needs to happen in order for us to see alternative investments really be prevalent in all of your clients' portfolios, again, at scale.
You said smart contract. Explain what a smart contract is in this case. Like, what exactly is it doing? Because I feel like I get these questions and people they hear the term and they kind of know what it means, but they don't actually understand what it's doing and how it works.
It's a fair question. I would say a smart contract you can think about as a representation of a fund that you own on ledger. So it represents obviously the underlying fund, the investments it has in it. It has your investor profile attached to it, so it knows that Jason Broder owns XYZ fund. It also has, again, built-in logic, so it knows, okay, tomorrow there's a distribution and we're going to spin off $1,000, and we know Jason custodies his assets at Bank of America, and here's the transfer instructions so the wire can happen seamlessly. It knows if there's a capital call to instruct Bank of America to send the money to the GP's custodian. Again, it's a smart contract because it has the validation and built-in rules engine that can really help streamline all of this, that quite frankly makes your lives very, very painful today, and it makes the lives of the alternative asset manager arguably even more painful to manage all of these. When asset managers had very large pension funds or endowments writing $500 million checks and they had to manage 50 investments per fund, it's not that onerous. But when you think about the evergreen products that are out there, the Blackstones, the Apollos, KKRs, and now you have 50 investments at thousands and thousands, you can appreciate why you need the scale and efficiency to streamline that process.
So let's move on to talking about some of the stuff going on in the fund world. In my experience, a lot of these funds, there's billions of dollars in tokenized products on chain, tokenized money market funds, and there's people using blockchain, digital ledger technology to do things like take the place of a transfer agent, which most people don't even understand what that means, but this crowd probably does. But in most instances, Jenny, the CEO of Franklin Templeton, was on stage yesterday, and she said they're basically running the old school way of keeping track who owns the shares alongside using blockchain technology, and they're doing them in parallel as like a test case with the SEC. And she said it's so much cheaper and more efficient for them to do with the technology side of things. Tom Lee was on this stage an hour ago saying that tokenization is going to make bank stocks trade more like tech stocks with higher PEs because they're going to have a lot of cost efficiencies. From my point of view, the costs aren't that cheap. Like if you look at some of the interfaces, the UI, the UX, the fees aren't that high. I mean, aren't that low, despite they're supposed to be lower. And I know people are talking about that, but like, when is that coming? What is the holdup here before we actually end users start seeing the benefits of this stuff?
Yeah, good, fair question. Maybe taking a step back. The financial system can work better built on blockchains. And all we're talking about is putting the things that we use on the financial system, assets, on blockchain infrastructure. And that's going to give us, first, more functionality, the ability to make payments cross-border, settle instantly, these types of things, interact with smart contracts. It'll take a little while before it drives down cost, right? So cost is not quite there yet. We are seeing competition on cost in the places where the cost is highest in the traditional financial system. So cross-border payments in emerging markets. That's the most expensive type of digital payment that you can make, and that's where stablecoins make the biggest inroads. Equity trading is very efficient. So it's going to be a while until equity trading on blockchains is as efficient as in the traditional financial system. But cost is only one thing that drives users to these products. The functionality, the cross-border payments, the integration with smart contracts, the ability to settle on weekends, the access for investors that are outside the United States. This is why there is adoption for these things already. Why do young people that are in college, messing around in their dorm room, why are they so drawn to something like crypto? Well, part of the reason is that it's more intuitive and easier to use of the technology than it is your brokerage account. It's more natural to use these things, and those are the types of functionalities that you're going to get by tokenizing assets, and it'll take a while before we totally reach mainstream adoption, and cost will be a big piece of that, probably the last piece of that story.
So what does this future actually look like? There are people out there who thinks it's like fully open source, which one of the cons I would say in that case is like you don't necessarily have someone to call, but that's not what you guys are building. But like the other side is like there's going to be special purpose blockchains built, but when you do that you get fragmented liquidity. It's not all interoperable. So I guess like, is it going to be mostly on this open source built on top of something like Solana or Ethereum, or is it going to be more in the way we're seeing Stripe is doing? They're creating a purpose-built layer 1 for stablecoins, Tempo. Is it going to be, there's going to be some special blockchains that spun up to handle alternative assets, so there's going to be special one for equity. Like, how do you see this future going? Is it all going to be on purpose-built chains or general use chains?
So what we did at iCapital is actually use blockchain called Canton. So all of the distributed ledger technology that we've launched is built on top of the Canton network that's founded by a company called Digital Asset. The reason we did that was it was a few-fold. Number one, it was already adopted by several financial institutions, like Goldman Sachs is a good example. Number two, the reason why we wanted to focus on something that, we'll call it semi-private, is because obviously when you're sending money back and forth and when you're transacting in private assets, PII is key. And the security and privacy components of the Canton blockchain was a critical component in our decision-making process. The one other piece that I'd add is there are other distributed ledger technologies that have popped up there, and we've had real conversations about the interoperability concept. I think it probably happens at a certain point. I think you just need to get a lot of people comfortable that in doing so, you're not breaching any of the PII pieces that really are the benefits of what we thought the Canton network, as opposed to Ethereum, which is clearly a public blockchain. We just weren't as comfortable with that, given feedback we had from clients over the years before we had made the investment.
Let me jump in. It's sometimes fun when there's more of a debate on these things. So I'm going to make the case that most of this activity will take place on public blockchains like Ethereum. And if you want to invest in this idea for the longer run, that's the investment that you're supposed to make, is to buy the Ethereum token or assets like this. There may be some others. Look, all these points about privacy, personal information, compliance, these are all really, really important recourse, really important pieces of how the financial system works today. And it's natural that traditional financial institutions are only willing to put a toe in the water in blockchains, to start. They need to care about all of these things. But that is not the bigger vision. The bigger vision is that we can put all of the world's assets on a common platform. And the only way that you can do that is to have something that is not controlled by any one party. It's a public square. It's a permissionless place that has its own set of rules governed by economic incentives, that's not controlled by the US government or the Chinese government or the British government, something that is fair for everybody to use. That's what the vision of public blockchains like Ethereum is all about. So yes, are they a little bit clumsy, a little bit janky, not have all the privacy stuff figured out just yet? Absolutely, that is the case. But we're never going to achieve the kind of full vision of this technology if we stick to these private chains. So they're an intermediate solution, a very natural solution. And I'm not surprised to see so many of them, because private companies, they want to make revenue off of this technology. That's why they're all standing up these blockchains. Ethereum is not giving any revenue to some company. It's a public, permissionless, decentralized network, right? And so yes, it has some things to work on, but that's really where the vision is going. So I would encourage you for your own investments to think about what that means. And for me, definitely, it's things like Ethereum are much more likely to win in the longer run than these private blockchains.
So I'll push back here a little bit, because I'll use the Austin Campbell, who's a professor at NYU, gave this example. But like, I think it makes sense, right? Because if your wallet gets hacked and your Ethereum or Bitcoin gets stolen, that's not coming back to you. Like, those are bearer assets. That's the way they're built. But when we're talking about tokenization, real world assets, RWAs, whatever phrase you want to use, like, if that gets hacked, there needs to be some way to go back. And it's like,
I agree.
Yeah.
We need to have all this stuff. We need to have legal recourse. We need to have privacy. We need to have all of these types of things. At the risk of going too deep into crypto stuff for a broad audience, we have the ability to do that with Ethereum with something called Layer 2. So we have this Layer 1 Ethereum network, and we can build any kind of specialization on top of it, customized specialization. So Sony has a Layer 2 on Ethereum that it has its own priorities for. Robinhood is building a Layer 2 on Ethereum. Coinbase has a Layer 2 on Ethereum. So it allows us to have these sort of independent little nations with their own legal rules built on top of this network. But we can always fall back to this decentralized, permissionless kind of core platform.
but theoretically, if you have, like, I don't know, North Korea steals the title to your grandmother's house, and it's on Ethereum and it's put into the blockchain, like, if it's immutable, a public town square, and no one can go back and reverse it, like, how does that work in a tokenization world, or a stock, or a bond, or you name it? Like, right now, it's the courts take care of it, and, you know, the banks undo those things, and
those sort of legal rules would have to exist on a layer 2. We want to create a platform that the Chinese, the North Koreans, the Europeans, and the Americans can all agree is a sort of neutral platform, and these assets really are bearer instruments. When you put a bar of gold in your basement, it is your personal responsibility to make sure that you keep track of it all the time. And so when you use one of these platforms, it is important that you have your own personal security, you know, your own kind of financial security around these assets. So, you know, it does feel like a leap for people to, you know, move entirely to that permissionless space, and it'll take time for us to go all the way there. And we're not going to get rid of all institutions. You know, get rid of the idea that the kind of purist libertarian vision of crypto is going to be the end state. That's not going to be the end state. Obviously, I think we can see that already. There will be all the types of legal compliance, privacy-related aspects that we expect of the financial system. We have regulation for stablecoins in the U.S. now passed in July. Congress is working on regulation for the rest of the crypto market. That's got started this month. We hope to see that by the end of the year. So we can have both things. We can have big, permissionless, open, global platforms that aren't run by a single company. I mean, who wants all their financial assets to sit on the Microsoft blockchain or the Facebook blockchain? I mean, that sounds crazy, right? The only way this is going to work is if it's a large, global, permissionless platform that anybody can access.
Do you have any thoughts?
I appreciate that. To me that it seems like the theoretical way to approach it. Yeah, and it's not wrong, and I think idealism has its place in time, of course. I wouldn't be comfortable if my assets were, on the Microsoft blockchain or the Amazon blockchain, and so I don't necessarily, whether you self-custody or bank at JP Morgan or Goldman Sachs or Merrill Lynch, I don't see those financial institutions going in this direction because I don't think their customers are going to be comfortable. Could that change in 10 years? Sure. I just don't see it.
They are not going to go in this direction because we are disintermediating banks. I quit my Wall Street career because you cannot disintermediate the financial system working at a mainstream financial institution. So yes, we're coming after the spreads of the banks, the brokers, the credit card companies. That's exactly why big institutions are not into this stuff, because we are coming after their vig.
And I appreciate that. But if you look at, the Betterments of the world or the Wealthfronts of the world, which I think are here, I think they tried that with robo-advice 10 years ago. I think consumers feel the trust factor with their financial advisor, and so I don't think that it's going to be very hard to peel them away. Maybe if you're a younger generation and you grow up, and it could be different. But again, that's why I think we've been focused on leveraging the distributed ledger to drive efficiencies and scale into the private market space, as opposed to, the theory behind the nirvana state that you've talked about.
Maybe I am an idealist about this technology, and I believe that people should have their money invested in these assets for this reason. Let me bring it back to reality a little bit. Grayscale is a financial intermediary, so we're not going to get rid of financial intermediaries, and part of the reason people trust us is that they don't feel comfortable custodying their own crypto assets, and so we help them with this process, investing in this technology. So look, it's a spectrum that we're not going to get rid of all institutions, but I do want to push back on this idea that Ethereum or these public blockchains don't have a role to play in tokenized assets, the kind of theme of this panel, and that we're just going to have all these little private blockchains started by every fintech and every bank and every broker on Wall Street. I mean, to me, that is not the vision. You have to pool the liquidity and the developers and the applications into a common place in order to get the value out of the tech.
Before I move on, we're going to save 5 minutes at the end for questions. There's a QR code in the back left over there from us looking on the stage. So if you want questions, you can put that into the Slido app, and we'll answer them for you. Let's talk a bit about cons, right? So in my point of view, like when you look at how our financial system works now, how markets work, there is batching of trades and settlements, and that kind of takes care of fraud. It doesn't have a lot of costs. Atomic settlement, where it settles instantly on these chains, that means there's going to be a lot more transactions. Even if they're cheaper, there's still more. And there's a lot of things that don't get to happen when you're batching trades. It's like when you go to the bar, you're going to put your credit card down every single time you get a drink rather than just paying your tab at the end, right? So another con, if you're doing this open source thing you're talking about, right now, what Jason was saying, you can call somebody, you can interact with them. Who do you call in this world that you're thinking of? What are some other cons that you hear from clients when they're asking you these questions, and what is your responses to them?
Well, the biggest thing is that the assets aren't there yet. I would like to have more of my assets in this space, but the kind of availability of assets to buy is not there. Maybe give one more specific con that can motivate the point of our products. Look, I like all this stuff too, but I have a family. And if I were to expire, when if I get hit one of those Harley Davidsons that drove behind us, is my family going to be able to know how to use the private key or the password, if you will, to find all the Bitcoin and the Ethereum and the NFTs and all that stuff. I mean, I just tell my wife, go call Grayscale, the team at Grayscale, to help you sort it out. So it does require an element of personal responsibility. So things like estate planning, rights of survival that we have in our brokerage accounts, these are important elements of how our system works today, and it is a con. I think fair to say we have not built out all that infrastructure in the world of tokenized assets, and you're going to need it for people to put their wealth on these platforms in the longer run.
So is your future, both of you guys, is most of this going to be happening on the back end and people just aren't even going to realize that they're using this, or are they going to know that they're using a wallet? Like right now, there's products out there that people have no idea that this is built on top of a blockchain. Is that the future that you see? Is that what you're expecting?
Yeah, I think it is. I think it's an underlying infrastructure where you're having your UI or your enhanced UI on top of it, and as a financial advisor or a consumer, you won't even know that it's going on under the hood. It's like if you use Plaid right now to transfer money to and from bank accounts. You don't really know what Plaid is. It's more of a pipe, but we view that at iCapital almost being like the Plaid of private markets, which is what we're trying to be on the distributed ledger technology. So hopefully that answers.
Yeah, I think for alternative assets, for kind of, let's call it like, real big boy assets, like all your wealth and stocks and municipal bonds and whatever else, that this is probably going to be true mostly behind the scenes. I do think people are going to have an experience with digital wallets that not everybody fully appreciates yet. I mean, you kind of know what Venmo is or whatever. Look at your bank account online, but digital wallets can take us a step further, where you're going to have your money and your assets in a common place, and you're going to be able to make peer-to-peer transactions in a way that you're not doing yet today. You can make payments in that way. So if you want to get started, if you want to understand why I'm so excited about this technology, try something like the Phantom wallet with a PH. That's usually what I start people on. If you want to dip your toe in this stuff and experiment with something, download a Phantom wallet and try out the Solana blockchain, which is cheap, fast, very easy for retail. So I think that's a new experience for a lot of people. And typically when I'm trying to activate people about, the benefits of tokenization, that's often where we start. Just try it out and see. Maybe I'm wrong. But I think usually when I show people, they're like, oh yeah, I get it. This is something new. I can see how we can take the financial system further with this technology.
Yeah, UI UX is definitely improving drastically from when I started looking at this space. You mentioned ETH, and then you mentioned Solana, because Phantom's a Solana wallet. I don't think Jason can really answer this question, but you can. There's advisors in the audience. People want to know, okay, if this tokenization is the future, where do you bet on it? Tom Lee says the banks are going to have much higher PEs and way more profitable.
I don't understand that argument, but I will take it up with Tom later.
Yeah. It's aside from Ethereum, I guess Solana theoretically too. How do you bet on or bet against it? If you don't think this is the future, how do you bet against it?
The most important thing is to not miss crypto beta, right? The crypto asset class is a $4 trillion asset class today. The whole global hedge fund industry, for example, is only $5 trillion. Private credit is a $1.5 trillion asset class. Crypto is a $4 trillion asset class. It's producing good returns, relative, risk-adjusted returns relative to its volatility, with a low correlation to stocks, and many people are just missing the boat. So I would say first step is allocate to the beta in some way. Buy Ethereum, buy a market cap weighted basket of crypto assets. That's the most important message that Grayscale has to offer. Just don't miss this opportunity that we think is sitting right in front of you. Now, specifically for tokenization, Ethereum is really the natural place to start. That's where the largest balances of stable coins are, where the most tokenized assets are today, where the most decentralized finance infrastructure is today. So the cleanest bet on the tokenization trend, the stablecoin trend, is just to buy Ethereum. And I have the ticker of our fund on my hat, so you can't possibly miss it.
Do you have any thoughts on how to bet on or against this tokenization trend that you're allowed to answer? I'm not allowed to answer it either. So.
Again, from our perspective, we're neither bullish nor bearish on crypto assets, but we are very bullish on leveraging the distributed ledger technology as the underlying infrastructure to uplift alternative investments.
Yeah, it's kind of crazy. I feel like back in 2017, the whole thing was like blockchain, not crypto, or blockchain, not Bitcoin. And I was never in that camp. I was like, you need some sort of incentive to keep this other than just some company doing it. But it's funny, like it's 2025, and like that is kind of what the booming part of this has been.
But can I make a point about this real quick, just for clarity? Bitcoin is the biggest asset in crypto. When people think crypto, they think Bitcoin, obviously. And Bitcoin is not a tokenization trade. Bitcoin is digital gold, and you buy it because our fiat money system is sinking, and we can talk about that totally separately. So Bitcoin is sort of first stage of the rocket, right? That's the thing that's sort of driving the crypto asset class today. It's this macro demand for a digital store of value. All this stuff about tokenization, DeFi, stablecoins, that's sort of the second stage of the rocket. It's going to take longer for that to reach full maturity, and that's what's going to keep driving the asset class. So the asset class is complex. It is Bitcoin. It is blockchain. It is both of those things, and you need to kind of get your head around both concepts to, when you're investing in the space.
All right, we've got a few questions, and they're actually pretty good questions. So is tokenization solving a real problem in my practice, or is it just adding complexity for marginal gain? I think this is probably better for you since you're building infrastructure for alternative assets, but if you don't have...
Well, for alternative assets, because we're not tokenizing funds today at iCapital, I would make the argument that I don't think tokenization is solving a real problem in your practice. I think distributed ledger technology is helping you purchase alternative investments because it will ultimately make it a lot more seamless or frictionless to do so, but that's irrespective of the tokenization concept. Again, I'll go back to what I said in the beginning. Just because you tokenize an illiquid asset doesn't mean it's any more liquid.
Yeah, that's people were saying that about ETFs too. Like if you put in a liquid asset in an ETF, yes, it can trade more freely and easily, but if the underlying asset seizes up, the ETF is going to have issues too. Same thing would happen with any sort of tokenized asset. Do you have any?
I think that was good. Yep.
Yeah. Okay. If the motivation to use tokenized assets is speed, efficiency, and cost savings, how do you rationalize investment case for an L1 tokens like ETH? Why are people coming to tokenization for cost savings going to be paying gas fees? Gas fees, just for clear, is like when you do a transaction on one of these blockchains, there's costs, and usually it's paid in the underlying asset that you're using.
Yeah. I think it is fair to say, again, to talk about the cons and bring myself back to reality. The technology is still a work in progress, and we don't have all the issues sorted out. In the future, you're not going to have to pay gas fees with Ethereum. You're not going to have Ethereum near the wallet. The software will abstract that for you. It will do all appropriate conversions and that sort of thing. Crypto started with hobbyists that were willing to go through a lot of challenges, to use the technology, and we're getting beyond that. Think about the internet in the mid-90s, right? Where just getting to the point of web browsers and bringing many more millions of people online, that's kind of where crypto is today. Not everything is perfect. We're just getting user experience that makes it easier to bring the masses onto the blockchain, and all these sort of things like gas and transaction fees are going to be one of the things that privacy, all the things we've discussed, are going to need to be upgraded to get the full vision.
Yeah, and the other thing, to the question that was asked earlier about benefiting their practice, a lot of this might not actually benefit you, but it might drive down costs for your service providers. That's the huge future. Like, you might not even know it, but like, there's costs for having a transfer agent. The DTCC is not free. Like, there are all these things that happen in the back end that 99.9% of people don't even know is happening. And if that is all done by technology and you don't need people watching over it constantly and taking care of things, that will also drive down costs and benefit the end consumer. We got time for one more question. What types of liquid assets are RIAs most likely to see tokenized in the near term, and how can they integrate those into client portfolios?
So we've seen certain alternative asset managers come to market, and tokenizing certain funds. So you saw KKR do it. You saw Hamilton Lane do it. Right now, everything is B2C. So if you're a consumer, you can go on Securitize and you can actually purchase one of these tokenized funds. We haven't seen anything B2B2C, and I think that's a function of the fact that, again, many of your clients don't want to convert USD to stablecoin and put it on a digital wallet and use that to purchase these tokens. So right now, I've not seen anything being offered to the RIA channel, at least as far as illiquid assets being tokenized, but of course, given the buzz, I'm sure in the next 6, 12, 18 months we will.
All right, we got 30 seconds. How does tokenization change the due diligence process for RIAs advising on alternative or traditionally liquid assets? Illiquid assets, sorry.
I can take this one combined with the Wood distributed personal ID tokens help in transacting. I actually think yes. Think about if you had a representation of your client as a tokenized, call it person, and it included KYC, AML. So when your client wanted to buy something from alternative investment manager number 1, 2, or 3, they don't have to go through all that process over and over again. It has your liquid net worth. It has all of your up-to-date documents like passport, license, etc. And I think that is actually a very good use case of tokenization. And when we talk about streamlining the process, that could be a very powerful part. It would make your guys' lives a lot easier, not to mention the lives of the asset manager. And I think when you put all that in a blender, to the point just brought up, that does lower overall transaction costs, or that could lower overall transaction costs.
Tokenized compliance does seem like the future.
Yeah, and I would also add, you can use zero knowledge proof. So like if you only need to share one part of that digital ID with one person, you can still use it, and not everyone can see like what the client's net worth is or income or you name it, any sort of personal identifiable information. You can just be like, this is proof that I have this, using a zero knowledge proof, which we don't have time to get into. But that's it. That's all we have. We'll be around for questions afterwards if you'd like. Thank you.
Thanks, everybody.